Well, hello again. Welcome to the Playbook. We've talked about why you invest, compound interest, and what you're actually buying, real business ownership. But knowing these things doesn't make you successful. Most people know them and still fail. Today we'll talk about two concepts that separate winners from everyone else. Section 1. The punch card. Imagine a magical card, 20 punches. Each punch is one investment decision for your entire lifetime. 20 decisions. Done. No more investing. Think about that. One decision every 2 years if you live to 80. Now, most people don't have this card, so they treat every decision the same. Invest today. Change the mind tomorrow. Sell. Buy again. Panic. Sell again. Over a year, 50 decisions, maybe more. But with a punch card, you'd think differently. You'd ask, is this truly exceptional or just ordinary? Because I only have 20 chances total. This single shift, from unlimited to limited, changes everything. Section 2. The case study. Impatient versus patient. Let me show you two real investors, both smart, both disciplined about some things, but very different approaches. The impatient investor, age 25, invests in trendy tech stock everyone's talking about, drops 20%, panics, sells, loss. Age 26, buys biotech company, excited about cancer research, no FDA approval, stock crashes, total loss. Age 28, buys Apple, good decision, stock rises, but after 18 months he gets bored, thinks it's peaked, sells for 15% gain. Fact: Apple grew 500% over the next 20 years. He missed it. Age 30 to 45, makes 40 plus more trades. Small wins, small losses. Fees eat returns. By 50, he's made 100 decisions. Portfolio is mediocre. Returns are average. Exhausted. The patient investor, age 25, spends 3 months researching. Finds quality company with durable competitive advantage, trading at discount, makes first punch, holds. Age 26 to 34, market bounces around. He waits, continues researching, no new punches yet. Age 35, market crashes. Now he finds another exceptional business, second punch, invests, holds. Age 40 to 49, both positions compounded beautifully. He's not touched them. Made only 2 punches total. By 50, he's made maybe 6 decisions, but each was exceptional. Each was researched deeply. Each was held patiently. His portfolio? Worth 3 to 5 times more than the impatient investor. Same starting capital, same market, different discipline, dramatically different results. Section 3. The principle. Here's the principle. Assume you have limited decisions. This forces quality thinking. When you feel you have unlimited punches, mediocrity is fine. You'll make another decision next week. When you have 20 total, you wait. You research. You demand that it's exceptional. Only exceptional opportunities deserve a punch. And when you don't have an opportunity, you do nothing. You hold cash. You read. You think. Most people find this unbearable. They feel like they're missing out. This feeling causes them to fail. The successful investor is comfortable doing nothing most of the time, acting decisively when opportunity is exceptional. Section 4. Margin of safety. But here's the problem. Even exceptional opportunities can disappoint. You will be wrong. Even smart people are. So when you invest, you need protection, a margin of safety. You analyze a business. You estimate it's worth $100 per share. Stock trades at $100. Perfect match, right? Most people buy here. You don't, because you know you could be wrong. What if it's only worth $70? What if competition arrives faster? What if demand declines? You demand a discount. You'll only buy at $70. That's 30% margin of safety. Why? 2 reasons. First, if you're wrong and it's only worth $70, you still break even. Second, If you're right and it grows to $300, you bought at $70 instead of $100. That's $30 more profit per share. Section 5. The math. Let's use real numbers. Investor A buys at fair price, $100. Business grows to $300 over 20 years. Return, $100 to $300. That's 200%, about 8.2% annually. Investor B waits, buys same business at discount, $70. Business grows to $300. Return, $70 to $300. That's 328%, about 9.9% annually. Same business, same growth, same 20 years, but Investor B earned 328% versus 200%. That 1.7% annual difference, compounded over 20 years, is $128,000 more profit on a $70,000 initial investment. The margin of safety didn't just protect downside, it amplified upside returns. This is why successful investors obsess over buying at discounts. It's not luck, it's mathematics. Section 6. Real case study. Berkshire Hathaway. Warren Buffett made his fortune through this exact approach. In 1983, he bought Nebraska Furniture Mart, paid cash, $60 million, fair price, no negotiation. Why? Because the owner, Rose Blumkin, was 89 years old and had run the business brilliantly for decades. The business had a moat, customers loved it, competed fiercely against other retailers, had strong brand loyalty. The price was fair, not cheap. But buying an exceptional business at a fair price beats waiting for a fair business at a cheap price. Over 40 years, that single decision became worth billions. One punch, one exceptional business, decades of compounding. He didn't own 10 furniture stores hoping one worked. He owned one truly exceptional business. Section 7. The principle. Combine these two concepts. First, treat your decisions as limited. This forces selectivity. Second, demand a margin of safety. This protects you. Together they create this. You make few decisions, but when you do, they're exceptional businesses bought at discounts. These compound for decades. That's how real wealth is built. Don't worry about the mechanics yet, how to calculate that $100 intrinsic value. That comes later in the valuation tier. Right now your job is simpler. Understand that margin of safety exists and that successful investors demand it. Next week we talk about how to recognize which businesses actually deserve investment. But before we go, if this is valuable, please subscribe. Hit the bell icon. YouTube won't show you our videos unless you do. Subscribe, share this, and I'll see you next week.